The beers are flowing. So before I get into premium finance too deep, one of the things I like to make this akin to is there's a lot of people here from California.
Yeah.
If we went into Newport Beach and we were going to buy a commercial building for $3 million, do you think we would use our own cash, or we'd go to a friendly lender and borrow it at, say, 3% or less than 3%?
Yeah, we'd use leverage.
We'd use leverage.
Yeah.
We do it with real estate all the time. Our wealthy clients, they get it. Yeah. They appreciate it. They've made their fortunes doing that. All right? We've all just talked about 7702. We all agree that it makes sense for diversification. What if for our very wealthy clients, and when I say very wealthy, $5 million in net worth or higher, and an annual income of 500 grand or greater? That's how we're going to quantify wealthy. What if instead of me asking them to part ways with 100 grand, 500 grand a year to put into one of these plans, what if I had the bank do it for them and they just service the principal and interest? Leverage, the same thing they did with the real estate. So with that, JT and I are going to roll through. This is a very simplified piece from Playbook 2, and it just shows, again, compared to what? Non-financed versus financed. Why are we even having this conversation? And it doesn't matter what anybody says, dealing with banks, dealing with lenders is a pain in the ass. It always will be. For the real estate deal we just talked about, for the life insurance, for your boat, your helicopter, your airplane, dealing with a bank is never going to be fun. But here's why you might want to think about doing it.
One other super high level, because this stuff can get complex, but if you bring yourself and bring your client down to debt and equity, very elementary, very important. We have a debt component, we have an equity component. When your equity outweighs your debt, you're in the black, that's a good thing. When it's the other way around, you're in the red, you need to post collateral so the bank's happy. Very fundamental, but remember debt and equity and what each one does, and we're gonna go through that.
So in the orange or yellow, however it shows up on the camera, you'll see we do non-finance. We have a 50-year-old they decided they want to put $50,000 towards this plan, similar to like a SEP. 50 grand a year goes in for 10 years. If they do that each and every year, they could expect to get an income of somewhere between $100,000 to $130,000 a year, tax-free. That's a really good deal for the rest of their life. And oh, by the way, there's a tax-free death benefit. We're not going to go into that. But what if we used that same $50,000 out of pocket and used it to service principal and interest? So we go to a lender and we say we need for our wealthy client, a tier 1 client, to borrow 500 grand a year each and every year for the next 7 years. And our client is going to contribute that $50,000 out of pocket, just like they were in the non-leveraged policy. The potential income, even after you pay off the bank via distribution, and the distribution is in year 16,
$5,800,000.
or 5.8 million bucks. Once you have done that, because you have all of this leverage at work for you, just like you do with real estate, the income goes up from the potential $129,000 to potential of $349,000. That's the power of leverage and why we talk about using premium finance for our wealthy clients. The ancillary benefit of this is these clients most of the time need very large death benefits. If they're making $1 million a year, them having the non-finance death benefit of 900 grand isn't going to cut it when you have to go talk to their spouse if something happens to them. If that death benefit jumps up to, I think it's close to 9 million, 10 million bucks, 9 million bucks, that actually could keep that family afloat if they lose that income. So a great way to get more benefit, and again, not the reason we're doing this type of planning, but that for a wealthy family can make a world of difference.
So I'm going to go back to, I like to keep it super simple. The difference between 349 and 129, it's usually between 200 and 300% desired benefit, in this case tax-free retirement income, by using other people's money, leverage debt. Now, let's call the spade a spade. When I use debt, I have increased my risk proposition. No question about it. And you need to understand that and be transparent with your client. There is more risk in the purple side than the orange side. Very simple. Now, there's also more reward. Risk versus reward. debt versus equity. These are simple blocking and tackling that you don't have to be a rocket scientist with this stuff. Let us serve that role. You guys talk about basic things, debt and equity, risk and reward. Another thing that I'm going to talk about here is we talk about the term stress testing. I was explaining to some of the advisors here today. Advisors clients, they're used to seeing what's the worst that can happen. What if this isn't rosy? What does that look like? What that looks like is the interest rate component could go up faster than we predict. That is a risk element. That's one of the main risk elements. The other risk element is this policy doesn't perform. What did I just explain? Debt and equity. My debt could go up faster than I predicted here. My equity could go up slower than I predicted here. Both could happen. What does that mean? When I go to repay the bank $5.8 million and my policy has about $6.8 million, if my debt was higher and my equity, my cash value was lower, I might need to come out of pocket to pay off that bank loan from an outside asset. Could happen. Your client needs to be aware of that. The other thing that could happen is this 349 could quickly turn into 200, could turn into 170. I could be off by 100%, meaning I forecast 340 and I got 170. But go back to compared to what? If I earned $1 more than 129,117 and I paid 50 grand for 10 years in both example, I would argue that that's a win. My benefit, if it's anything over 129, was a win. Is it as rosy as I hoped it be? No. But I want to talk about the downside. We believe this is realistic. We have assumed that this interest rate is going to go up 50% from 4 to 6 over a 15-year period. Could go up quicker. The irony is this was built 2 years ago. Rates that we're getting right now are 2.7. We're forecasting 4.25, raising 15 bips every year. They've gone the other way. We think they're going to come back up, but the point is we don't know when and how much. That's a risk element of this design. Risk reward. Our reward might be less rosy than we think, but it's still going to be better than the non-finance.
And to help your clients, we always bake in 3 stress tests that are not required by the carrier or the lender. The first one is we're going to show the interest rate going up somewhere between 10 to 15 basis points each and every year. And that's from the lender, not on the carrier, but from the lender.
Let's go into the numbers briefly. I'll kind of call them out. $500,000 loan goes directly into the policy from the bank. You are the borrower. Your company could be the borrower of the 500 grand. Interest rate's 4.25. You might be saying, well, I'm paying 50 grand, my interest is around 20. We're paying down about $30,000 in principal year one. If you look at this total loan, we borrowed 500 and it's down to 471. We kind of amortize the cost, some principal or some interest, the rest towards principal. It's important to understand that. Now, if we look at the policy value, I'm at $405,000. That's what I call equity. My debt is 471. It's not rocket science. The delta between those two, to keep the bank happy, they need to be fully secured at all times. They love this business, lending money to the wealthiest people, the best borrowers. They're fully secured at all times, and the equity component can never go backwards because of 0% contractual floor. All those things are very important. So my shortfall, external collateral, the delta between my debt and my equity, 65 grand. I got to scrape up 65 grand. Year two, it goes up about 55 grand to 121. You don't add the two together, that's a cumulative number. Collateral is not an expense. You're parting ways with that money, you're pledging it to the bank. You are not spending that money, it's your money, and that's important. Year three, 206, you can see it peaks at about 340 in year 5, and then it tapers off and goes down. After about 7 years, I mentioned debt and equity, we're now in the black. our equity in our life insurance policy, the cash value, outweighs our debt. That's a very important time in this design. Your clients are now essentially unencumbered. They can bail and exit the transaction if they wanted to as soon as your equity outweighs your debt.
And what he just touched on was the second stress test. The first 3 years, we run that you're going to get a 0% rate of return from the index policy to make sure that the collateral is about as high as it's ever going to be in the transaction. We don't have to do that. We just want the client to understand this is most likely going to be the most amount of collateral I get opposed.
One other thing that we'll do, depending on the advisor or the client, is we see here that in year 3 it's 206 grand. We'll a lot of times ask the client to literally pledge the 206 to the bank day one. They only need to pledge 65, but it's so important to get them mentally prepared to tie up some of this money. Nick Robb has done a bunch of this business. We were just talking about it. He's like, the worst in the world is going to a client and asking them for more collateral. Even though we promised that it would be that number, you could argue that if they're willing to pledge it up front, grab it while you can.
The third stress test is you'll see we took a distribution from the policy, this negative 5.8 million. We took a distribution to pay off the bank to get rid of the lending relationship. And that was in year 16 of this design. The cash value goes from $6 million down to $850,000. Most wealthy clients, as they start to appreciate, because we're illustrating these earning 5-6% rate of returns, when they see what their actual returns are, not the AG 49 returns, they start to think, well, maybe if I have an equity event, maybe they sell a portion of their business, maybe they sell their entire business, maybe they get an inheritance. They'll look to use those dollars to help pay down this loan. And when you do that, you use outside money rather than putting all the stress on the policy. This income number of the 349 goes through the roof. And we're gonna be on those annual renewals with you guys when you're doing this with your best clients. We're gonna help them explore those options. Because when they come to us and say, I'm getting ready to sell my business for $5 million, maybe we use $1 million or $2 million to help pay down that 5.8. That's what actually happens in the world of premium finance. So just know that that's something that we want to educate the client about, because it can make a world of difference to the back end income.
One other thing, I'm going to briefly cover the terms of the loan. These are very consumer friendly loans. They typically have no prepayment penalty. Very important for your movers and shakers. If interest rates spike and they get spooked, they want to stroke a check, be done with the bank, they still have the equity component. So no prepayment penalty. Typically no origination fees. These guys are used to paying points and fees and upfront costs. Almost none of that. There is a couple lenders that will do a documentation fee. It can be a few grand. That gets rolled into the loan. They're not coming out of pocket. But very low fees, no prepayment penalty. The way most of these rates are functioning, there's a base rate that used to be 1-year LIBOR. It's now transitioning into some treasury-based base rates plus a spread. Your spread is fixed and guaranteed, typically a 5-year term. Your base rate will fluctuate once per year for the 5-year term. So 5 times your rate will change or could change. That's a function of your base rate plus the spread, which is a known number. That's what dictates our assumed loan rate. So that's how the loan rate works. The last piece is collateral, what types of collateral we can use. Charles touched on that, and it's going to segue to our next concept. But
yeah, so in terms of collateral, what the banks want to see, they love life insurance. They invest in life insurance, so they'll give you dollar for dollar most of the time on existing cash surrender values. Cash, usually dollar for dollar. We can do assets under management. It's a little more complicated because you have to be able to get the clearing firm that you're with to be approved in order to do that. They're normally going to give us 50 cents on the dollar because those can go up and down with the market. And then lastly, we can talk about using something like a letter of credit, and that's typically the most expensive and a little bit cumbersome, but it can be done.
But your big real estate guys that have great relationships and borrow lots of money, they can typically, a lot of guys will say, hey, can my banker do this? In theory, they could, but they usually don't want to. Usually takes a specialized lender. We have 5 that we go to often. But again, The wealthy real estate guy can get a letter of credit from his favorite banker and pledge it to our specialized lender. It's a great way to potentially, work both angles. On the investment side, it has to be non-qual. The custodian, the clearing firm has to allow a control agreement on that account. He mentioned it's a 50% haircut. The good news about that, you guys get to still manage that collateral account. Most importantly, your client has no opportunity cost. If your client has to move $250,000 in external collateral into a money market or at our lender, a CD, his opportunity cost is a big number. If he can take and pledge investments, there is no opportunity cost. He can't liquidate it or access it. You guys can still make trades, and he uses that to kind of double serve its purpose of growth on the equity account and serving as collateral for this.
So that's a lot. We're going to help you with point of sale, because we just went over the lending and the carrier side. We just doubled the paperwork because of everything that's involved with it. The other thing, here's the trick of getting all this done. A lot of people want to talk about premium finance. Can you actually get it through underwriting? We just took the same client, 50 grand out of pocket. It was $1 million death benefit versus $10 million of death benefit. Getting $10 million established is harder. You need to know the underwriters, you got to know the carriers, you got to know the art of the dance to get them done. That's what we've been doing for a long time. We can help you position those. And I would say most of the value add is allowing us to help you with the point of sale.
By the way, from a revenue component, getting revenue commissions based off a $10 million deposit or a $1 million, big difference. Exactly 10 times the difference to be exact. So can be a very lucrative term if you have the right client. Let us help you conduct that. Let us sit on kind of the proverbial other side of the table. You sit on the side of your client. Let them and you challenge us with some of the stress testing. We're very transparent. We throw it all on the table. If they see the risk reward payoff, it's game on. If they don't, we move on, and so be it.
Premium finance.
Yeah.